Berkshire Hathaway just reported earnings. The stock is down 12% over the last year. I'm pretty optimistic on Berkshire. I have a contrarian bet on the company. I said they could be an AI winner, and people didn't really understand what I said, but I explained much more in this video. And it's a really interesting thesis if you're interested in checking it out. But if you look at Berkshire versus the S&P 500, Berkshire has mainly topped whenever Warren Buffett announced his retirement. And since then, there has been a massive spread between Berkshire and the S&P 500. Even though Berkshire owns companies like Coca-Cola, Bank of America, Google, and others, those companies are going up in value. So the book value of Berkshire is improving, but the stock keeps on going down due to a lot of uncertainties around the transition in leadership and the new CEO. And now we had the annual meeting. It's been going well so far. The company put up about 18% growth in operating earnings. That's really, really amazing. And before I talk about the operating earnings, I just want to highlight how cheap this company is. If you're buying Berkshire today at $473 per share, you're getting $184 per share in cash. You're getting $120 per share in the equity portfolio. And in terms of the operating earnings, like See's Candies and Railroad and Geico, in terms of how much you're really paying for them, you're only paying $184 per share, or around 11 times earnings. So you're paying 11 PE for an amazing company like Berkshire, and you're getting the cash, and you're getting the portfolio, and you're getting the culture, and you're getting so many different call options. So it's one of the most interesting bets I have seen in a while, and that's why I have a bet on Berkshire, which I'm going to explain later in the video. But in terms of the businesses, they did really, really well, especially insurance and underwriting. It jumped from 1.3 billion to 1.7 billion. This is a massive, massive jump. But the investment income has actually declined year over year. This is largely due to the company's investments in treasuries, and the Fed cut interest rates. So the treasury income declined by about 10%. Dividend income is still solid, but the treasury income, due to lower Fed interest rates, it declined by about 10%. But in terms of the insurance business, it was really, really good. In terms of BNSF, which is a railroad-related company, it also grew in earnings, but it didn't really grow enough. There's so much potential within the company. Because if you look at the company's operating margins versus, let's say, Union Pacific is almost 40%, and you have BNSF at 34. It was at 32, now it's at 34. So there's still massive runways on expanding the margins and working on pricing, and implementing AI and a lot of technologies within BNSF to make things more efficient. So this is, again, a growth company in terms of BNSF, but it's also a turnaround because there's a lot of upside. And it's also a AI-proof company. It's not going to be disrupted anytime soon. There's nothing more efficient than railroads, and it's going to likely be here forever. So this is a pretty amazing business, and it's also been doing better. Now, Berkshire Hathaway Energy is my favorite part of the business, but the growth has been really, really slow. It has a lot of potential in terms of data centers and AI to expand it. The CEO talked about this, but they haven't really delivered on that. Like, they haven't really been investing there. Maybe they have been, but we haven't seen the results. Now, my favorite part about the business is the natural gas pipelines. The natural gas pipelines grew 24% year over year, and this is a national security asset. Berkshire owns 21,000 miles of pipeline, and the pipeline in general covers or transports about 15% of the natural gas consumed in the United States. The entire 15% of natural gas consumption flows through the Berkshire pipelines. So this is a national security asset, a pretty amazing asset to own, and they want it for the long term. It has a lot of potential in terms of expanding power capacity in data centers and other things. Now, they unfortunately have a lot of wind farms, and they don't have enough the alternatives, you say, like gas turbines and nuclear, but they're working on them, they're investing there. So this is a promising business. Then you have the manufacturing business, which has shown some growth, but not a lot of growth. But if you look a little bit deeper at the manufacturing business, the manufacturing revenues alone grew about 10.2%. This is massive growth, but it was offset by services and retailing, which didn't grow as much. But manufacturing grew 10%. Now, Berkshire has a business that a lot of people don't know about, or they don't even know it owns it. And this business is called Precision Castpart. Now, Precision Castpart makes a lot of components for the engines and other components, not just for aircraft manufacturers' engines, but also for a lot of defense stuff, a lot of gas turbines that's used in the data centers. They all use parts from Precision Castpart. And the CEO highlighted that Precision Castpart has about a 10-year backlog for the company due to so much demand for the industrial gas turbine for data centers and so many different things. So this is also a data center related bet. It's growing 10% year over year, which is massive growth for a manufacturing company within Berkshire. But again, you have other parts of the manufacturing side like retailing and others. It's been weak, especially the furniture stuff and other kind of things. But this is an amazing business within Berkshire that not a lot of people know that Berkshire actually owns it. Then you also have the portfolio in terms of stocks. They have a lot of stocks, but the core holdings for them that they highlighted are Apple, American Express, Coca-Cola, and Moody's. I like all of them except Apple, but the market seems to like Apple very, very much. Then they have the trading houses in Japan. That was an amazing bet from Buffett because Buffett borrowed at low interest rates in Japan at about 1.2%. He borrowed the money at 1.2. He bought them when they were really, really cheap. They were yielding about a 9% dividend. So he got paid to own them. Now the dividend is like 4%. He's still getting paid. And he made, I don't know, maybe 100 or 200% on the upside, and he's still getting the dividends. So that was an amazing investment from Berkshire Hathaway. They're getting a lot in dividends from them, about $862 million per year. Amazing, amazing bet. And this is also one of their core holdings, and they want to keep them for the long term. Now, the company at the moment is trading at about 1.4 times price to book value per share. But there's something that's very interesting that the CEO said that I didn't know was happening, which is that companies like BNSF, like Geico, and all those companies, they are on the balance sheet based on their initial cost basis. So let's say they paid $20 billion for the railroad. Okay, maybe now it's worth $60 billion, but they did not mark up the value. They kept it at $20 billion. So the book that we're looking at is worth much more than where it is right now. So if maybe we have to account for what could potentially be the value of those businesses, the company maybe is trading closer to 1.1 time book value per share. And that's something that I didn't know. So really it tells you the value and a lot of the things that you're getting with Berkshire. But most importantly, don't listen to me, but maybe you could listen to the CEO and Warren Buffett, which they started buying back shares for the first time since 2024. So they looked at the stock, they looked at the valuation, they believe the stock is attractive, and they're buying back the stock. And those are not people that buy the stock every single day like AutoZone and Coca-Cola and other companies. They only buy whenever they believe it's below intrinsic value. So they're telling us the stock is below intrinsic value, we're buying the stock. And the market is still not listening to them. I don't know if it's going to listen to them after the annual meeting, but I believe Berkshire is undervalued. There's about a 37% gap between Berkshire and the S&P. So there could be up to 37%, in my opinion, upside in the short term, maybe 15-20% at least. Over the long term, I see about a 12-13% annual return. It's not going to make you a millionaire, but I see operating earnings growing 12-13%. I personally have like a put spread on Berkshire, which is mainly 400-390 put spread. You can Google them for January 2027. So as long as Berkshire is above $400 per share, I'm going to make a 12% return. That's it, pretty much. If it goes to 400, I'm still gonna make 12%. If it goes below, I could lose money. If it goes up 100%, I'm gonna make 12%. So I locked in 12% for the next 6 months, as long as Berkshire is above 400. And I think it's gonna be above 400 because if it goes down, they're buying the stock, and if the market goes up, the book value goes up, and Berkshire should do well. So this is the kind of trade I have on Berkshire. If you'd like to learn more about options and other kind of things, I teach them in my group. This is the link if you're interested. But I like the company, it looks undervalued to me, and I have some shares as well. And that's my opinion on Berkshire. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.